Hey, good morning, everybody, and welcome to this week's long form episode here on Mining Stock Daily. I'm Trevor Hall, your host once again. I apologize for missing last week with the long form, so we're going to make it up to you. We have a 2-segment, very long form, almost an hour and a half of content here, where we're first going to connect with my friend Zach Abraham from Bulwark Capital, talking all things general markets, a little bit of gold in there as well. And we have our first kind of quote unquote tariff deal with the UK out of the United States. So we'll see if that is it tangible enough to get the markets moving higher in a real substantial way. We'll see. A little skeptical on that. And then we turn and talk about agriculture, actually, with ClearCom contributor from the Business of Agriculture podcast, Mr. Damian Mason. So providing you a little bit more information and insight from an industry we don't necessarily get to follow a whole lot here on Mining Stock Daily, but I think it's worth your time to understand more. Special thank you to Caliber Mining, Visa, Silver, and Integra Resources for their continued support of this podcast. Please hit that like and subscribe if you haven't, and share it with like-minded friends, investors that are within your circles. All right, let's start things off with Zach. Have a wonderful weekend, everybody. Be well. All right, everybody. We got a great first segment here with our long form episode this week. Happy to welcome in the host of Know Your Risk Radio, and he's also the principal chief investment officer over at Bulwark Capital. I've been on Zach Abraham's show a couple times, but this is the first time Zach's been here on Mining Stock Daily. Not necessarily going to dive deep into the mining stocks, Zach, because there's just so much news and kind of headlines and trying to make sense of everything coming our way. But first, my friend, it is so good to see you on this side of the media platform.
Yeah, I know. I love flipping it around. I was just talking with Chase, how we, unless we do one of these, the only time I see is when we bump into each other at the Hidden Forces dinners, man.
In Argentina.
Which is
or no,
yes.
It was at Phoenix. In Phoenix we saw each other.
Well, yeah, me in Phoenix and then Chase in Argentina.
Yeah.
And speaking of which, he and I were talking about that. I think that'd be a really fun thing to do. Is I'd like to get on the ground and go look at some of these projects with you at some point. It's been a long time since I've snooped around a mine. And if you've never done it, it really, I think it really is as intriguing and fun as you'd think it would be, but I've always found it fascinating.
We can get you back to licking rocks and kicking some dirt around again, Zach, for sure. Happy to do that.
Well, now is the time, man. And especially when you look at, we're kind of getting to that point where we're starting to look down the value chain, because despite what's going on with gold, there's a bunch of these smaller miners that really haven't moved. And, the internal economics of these things are just getting, and I'm sure you feel the same way, but you're looking at numbers that you never, had somebody told me I'd see those kind of numbers, I wouldn't have believed them at some point, right? Like I would have never believed that it got this frothy.
Right.
But man, some of the most unbelievably priced securities and investment opportunities I've ever seen, if you believe that cash flow still matters.
Yeah, absolutely. And so that's obviously been an ongoing conversation here on MSD all week, and we've seen a lot of the quarterly financials come in. A few big misses, I might say, obviously, but a lot of big winners, and we're seeing that across the board. But really, the narrative here, Zach, is like the general market just still doesn't care. They don't care about valuations. They don't care about cash flow. They are still trying to buy this dip, trying to follow that quote unquote Trump trade. Here we are, 3,200 plus gold, and the GDX is below 50, not even close to its all-time high. So let's just table that conversation for a while and talk about the general flow of capital into this market. The president is coming out. He's going, obviously, on his Truth Social and getting reverberated through other media networks. He's literally out there pounding the table about buying stocks. That's today. I mean, he's trying to push this thing over. But the question is, like, doesn't he want a weaker economy to get some of this stuff, all these policies going that he, is deemed that most important for him in his last term?
You know, you and I were talking offline about this. I think that, in my opinion, I think he's sort of bidding against himself a little bit here. And I've been saying that about the market, generally speaking, because people need to remember something. We are not dealing with a domestic issue, right? It's not just about what Trump's going to do here. When you look at some of the domestic agenda stuff he wants to do, I think you can pretty easily make a bull case for equities here. I mean, they're still really expensive, but they have been for quite some time. The minute we start talking about, foreign relations and international trade, you have far less control, especially when you're bumping up against somebody like China. So then you think about the budget that he's got to get through, the reconciliation process they're going through, all that kind of stuff. I got to tell you, from right here, it doesn't look like he's got the votes. And I think that more than ever, politicians on both sides of the aisle are in tune to the price level of the S&P 500. And I think when there is pressure on the stock market, I think there is increased pressure on politicians to make deals. When the back end of the curve is fine and the market's ripping at 30, 32, 33 times earnings and hitting new all-time highs, I think that pressure is off. And so that might have domestic implications, but that does absolutely nothing, right, to address China is not more likely to cut a trade deal with us if the S&P is at a new 52-week high. Okay, that doesn't figure into their calculus. So if anything, I think it makes the political process on this side of the aisle more recalcitrant and makes the left more willing to stand against him. And I think it makes dissidents on the right more confident to stand against him. And yeah, I think that it puts upward pressure on rates. I look at the bid coming into XOP today, right? Oil, nat gas. I kind of feel like, what he wants to do, and it sounds weird to say this, but the things he's trying to accomplish, I think are best accomplished, with GDP growth somewhere between like 1 to 1.5% and the long end kind of just hanging in there. I think that's the right environment. But these are crazy times. But one thing, and I've kind of gone on here, but one thing that we have talked a lot about internally, and this is coming from a guy that actively manages money. We're not big, but all in all, we manage about 850 million. And we're active managers. We're not ETF riders. We're not closet indexers. We are traditional value fundamental investors. And so performance is a big deal for us, right? It dictates clients and professional risk and all these things we're dealing with. And I'm not saying this 100% confident. I think 100% confidence in this business is, preparation to get run over. I will say this though. I have found some intellectual peace in this environment because I think you're looking at an investment map where your choices are, I believe that cash flows matter to price, or I think that they don't. And considering my role as a fiduciary and a steward of other people's money, I don't have a choice when presented with those two options, right? So right or wrong, the choice is already made for me. I know which side I've got to go. I got to swing to. And so in that way, I kind of feel some peace and resolution in this marketplace because in my opinion, I think you're more off the map right now than I've seen a market ever. Or I think a parallel we've drawn is this feels very much like January of 2020 before the world realized that there was a global pandemic. So, I just don't really feel like there's much of a choice. There's incredible value out there, or you can go pay 25 times earnings for something that looks fraudulent. So,
ever since the quote unquote Liberation Day, it felt like this administration needed some sort of win, like it's something tangible, not just, words on a tweet that said something's coming, earth-shattering agreement, or as they say, that's basically hyperbole. I think people are starting to see through that pretty dang quickly. So then this morning, we get this news that there is probably a deal between the U.S. and the U.K. It's not huge, but at least it's a start. I guess it is tangible, but they're talking about decrease tariffs on resources such as aluminum and steel. And so I had to go and look, and it's like there is no manufacturing in the UK anymore. How much steel and aluminum are we getting from the UK? It doesn't even crack the top 10. So like there's a nothing burger in my eyes. Like, okay, well then what, the vehicle, the UK vehicle. It's like, okay, well that's something. The Land Rovers, the Jaguars, obviously vehicles that a higher, income level echelon people would buy. They don't give a shit about the tariffs, whether it's 10 or 25%. They want a new Land Rover, they're going to buy it.
Right.
It's plain and simple. And I actually was just kind of curious. It's like, maybe it's kind of like BMW, where it's got, the German brand, but a lot of it's manufactured here, so they kind of forgo the tariffs. No, it is manufactured in the UK and has to get shipped over. So again, it's like, it's not something that really affects a lot of people. It is something, but it's like, why, this is so small. Like, I do think if there is going to be something tangible, obviously you have to bring China to the table. I mean, and that's a whole nother conversation itself, Zach, but it's like, Mark Carney, the Prime Minister of Canada, was in the Oval Office this week. I mean, that's got to, like, why not just really focus on that? Get this U.S.-Canadian ties back together and moving forward succinctly.
I would completely agree. And just full transparency, I am generally speaking in favor of having this trade confrontation, generally speaking, at this time. And the logic for that, in my opinion, so many of these issues have been punted for 35 years. And as long as you keep punting these issues, they're going to continue to metastasize and grow and become even more, malicious and more damaging to our economy. So I think this confrontation, in my opinion, and I think if you have this confrontation in the right way, it lessens the likelihood of kinetic wars, hopefully, right? I'd rather have a trade war than a kinetic war. Nobody wants a trade war. Nobody benefits from it. But some definite serious questions as it relates to the rollout. I think that the administration is kind of realizing that they might have overspoken or overblown the leverage that they thought they had in these particular situations. At the same time, I think there are a lot of people that are underplaying the leverage they have, meaning, generally speaking, if you've got a trade deficit country like China, or like us, and a trade surplus country, and you have a trade war, it's the trade surplus country that usually hurts the worst. Now, China's a little bit different because they've got a closed capital account. There's a lot of other things to take into consideration. But to get to your point, why are we focusing on Britain? I think it's just trying to throw a win out there. I think I also have suspicion, and this is kind of a framework that Chase and I have been working on. Chase is our head of research. He runs Pinecone Macro Research as well. He and I have been working on a premise that he brought around. So I take credit for it, but it was his brainchild. But we've kind of worked on it together over the last 2-3 years, and the premise was, and it's kind of a little bit nuanced, but I think it's a big deal. It's kind of a tail wagging the dog scenario where we think that when you look at the percentage of household wealth that is made up by the stock market, I think it is a fool's bet to not pay attention to levels of the stock market and how they influence the economy, as opposed to how the economy, benefits, or how the economy is reflected in the stock market, right? So kind of flipping it around. And we really put this to test in the back half of 23, because we're like, okay, economically speaking, things were headed in the wrong direction. And I think people forget that, okay? Then all of a sudden, can't remember, a couple things here or there, and maybe it was the first Fed rate cut, maybe that was it. Anyway, market kind of bottomed there in the summer and it started taking off. And we were still keeping a look on all the manufacturing data. It wasn't good. But we started seeing the market take off, and we were like, okay, we're going to test this premise. If we're correct, if the market can continue to rally here, we should see economic activity picking up and following. And it's exactly what happened. And when you start looking if you go back and look at the 70s, what comprised somebody's retirement? It wasn't the S&P 500, right? It was a pension and CDs. That's what it was. Maybe they owned a few stocks here and there, but it was not at all the base of their retirement package, right? You flip over now, the S&P 500 has sort of become a retirement utility, right? This belief that every year it's got to keep going up and to the right, and we hodl, we never sell, regardless of valuation, regardless of fundamentals, right? And it's kind of become this thing that's Mike Green's done a ton of work on this. He was down in the dinner with us at Phoenix. We spoke about this. And so I think now the administration's never going to come out and say that, but I think they think as long as they can keep the stock market up, they can keep. And if you think about it, there's a real world example I've got here because we manage primarily retired people's money, right? In a year where the S&P goes up 20%, just ask yourself, look at the grandma and grandpa that are retired. They got 2.2 million in the retirement accounts. And in a single year, they get a 20% pop. That's a, $400,000, $500,000 pop to the retirement account. Do you think they're more likely to buy the extra G.I. Joe and the Kung Fu grip and the extra Barbie and the Barbie Corvette at Christmas? Or are they less likely after a 20% year? Unquestionably. Are they more likely to help the kids with a down payment on the house? Unquestionably, right? Flip around. They take a 20% hit. Do you think that's going to be reflected in their personal spending? Absolutely, right? Where in the past, when 90% of your retirement income was based on your pension and your CDs, you'd see, markets down 20, 30%, and you wouldn't see consumer spending blink, right? So, look at the 70s. You saw periods of times where, market was flat and consumer spending went through the roof over that decade. Inflation played a role in that. But now I think that, like I said, I think you've created this retirement utility. I think the administration is speaking to that and just trying to keep the market, feeding that cash into the system. But for somebody that has supported quite a few things of what Trump has done, when I hear him out there just pumping stocks at these levels, it's to put it nice, it's odd. It's odd. And like you said, we're rallying the S&P for 2% at these valuations because of a trade deal with the UK. Are you kidding me?
Yeah.
So it's odd times, man. Odd times.
Well, it's the emotional momentum, right? It's the same playbook, and I think what happens to get me more, and I've kind of tweeted about this a couple times with these policies, and I'm with you, Zach. Like I can, on the big picture of why he wants to get these policies moving, I can fully support. I mean, I think we're seeing the end of a globalization cycle because we're finally aware of the dangers of it. Because maybe we're aware of the dangers of it because it's too late. Maybe we're in that type of the cycle, and so we've got to quickly pivot. And to quickly pivot, you've got to break walls, you got to bust systems, and kind of restart, much like what FDR did during the New Deal. He didn't necessarily have this big grand scheme of what it was going to look like when he was done. He just knew the system he inherited was not working. And so
this is such a great point because I think guys like you are going to really try to call balls and strikes down the middle, regardless of our political proclivities, right? Mm-hmm. And unfortunately, we live in a world where most people have abandoned that. Even though I support the general idea, I've got no problem going out and criticizing the approach. Flip around, though, and so much of the consternation regarding, so now to speak on the pro side of the confrontation generally, you hear all these people just wringing their hands and freaking out. Oh, you're going to torch the system. Oh, you're going to kill the stock market. And you look at them and go, hey, guys, you act as if the status quo is viable, right? Mm-hmm. To your point. The system doesn't work. Yeah, we're going to break it, right? But because it doesn't work, it's incalcitrant. It needs to be broken. We need creative destruction. And I think to get policy on the right track and to get people on the right track, you got to sit there and ask them, hey, is this working? Has this worked for the average people? Has this worked for the middle class? Has it worked? Or does it mean we throw all of globalization on the trash heap of history? No. But what it does mean is, like most things, we overdid it. Okay, now to undo it, there's going to be some pain involved, right? And one of the things we talk about all the time here is, adult thinking, meaning life is full of cost and there's cost and benefit analysis. Nothing is cost free. And the cost of getting this on the right path, I think, like you said it, if we're really doing the things that need to get done, the cost of putting this on the right path is probably have stocks go downward to sideways for a few years, probably have some economic hits, probably have some lower growth, and probably even a recession, because I think that's what's going to require to make real change. If you don't do that, you might have headline tariffs, but then you look at the carve outs underneath, what's been happening pretty quick. You might have ceremonial tariffs and nothing else. No, so I'm not in favor of tariffs as a permanent practice, but as leverage to get a trade deal done, I think they can be effective tools. But like you said, I don't understand how pumping equities here helps in that scenario. And if anything, I think, especially as it relates, if you just look at Congress right now, how much more willing is any opposition to Trump going to be willing to dig in their heels with the S&P green on the year as opposed to down 20, right? Mm-hmm. So much more willing to dig in their heels. So, go think back to 08 or 09. Most people, that's too far back in the rearview mirror. Remember how they weren't going to pass TARP, and then the market just plummeted, and within 24 hours they had the votes.
Right.
So
yeah, I mean, everybody votes with their pocketbook. Just not just the regular voter like you and I. People in Congress vote in Congress with the pocketbooks as well, for sure. And I've been thinking about this a little bit more and more about we've come down. I don't know where we are, like 12% off the highs in the S&P, something like that.
It's like 8 now.
8, okay, 8. Yeah. But the fears of the GFC are still entwined in a lot of people's brain, and it's like, oh, we're going to repeat the great financial crisis. The house of cards is going to come crashing down. But what we see typically since then is, we have a correction, and then we V bottom and go straight back up. We kind of had a V, but it's not going straight back up. It's just kind of hovering there in the middle. Within the medium of those highs and the recent lows. And so, but there continues to be this uncertainty. And I just don't know, that recovery, people are uncertain that this thing's going to recover. People are uncertain that this thing's going to plummet, to another 20% low. And maybe this is are we witnessing, if you look at the chart, are we witnessing stagflation every day, where it just kind of goes nowhere, goes up one day, goes down the next?
Well, it's interesting you say that, because we are about, if you go back to now, it's obviously the markets have moved a lot, but when we were at the bottom this year, we were about 3% above the same level we were at in November of 2021. Okay, now, if you averaged out inflation over the last 4 years, I would think, and I don't have those numbers in front of me, but I would think you at least had to average 4.5 from late 21 to today, right? If you add it all up, doesn't that seem reasonable to you? Does that sound reasonable?
Yeah.
4.5?
Yeah, sure.
Okay, so on a inflation adjusted basis, the S&P is negative for the last 4 years on an inflation adjusted basis. So to your question, I'm not saying that's where we're at, but I am saying if you've got a negative net return on a real basis over 4 years, that kind of sounds like stagflation, right?
Yeah.
And one of the concerns that I've got, one of the things that has gotten our allocations to drastically change. We still own US. We're just far less exposed than we were. And I've heard all the people saying, yeah, we've heard it before. How many times have we heard this warning? The US is finally going to tip over. The one thing that we do think that kind of portends to this maybe being different, maybe this actually being somewhat of a real top, again, you're negative on an inflation adjusted basis over the last 4 years. And for anybody to say that that's a normal occurrence in U.S. markets, it's not. It's very rare for that to happen, even over a 4 and 5 year basis. And, you know, I think you're looking, when you see, I think that we had a perfect storm. The U.S. market became, at its peak earlier this year, was 70% of global market cap around the world. So we have an economy that makes up 25% of global economic output, and yet we were 70% of market capitalization, by far and away a record, not just for us, but for any country in the history of financial markets. No single market has ever made up 70% of the market capitalization of the world. Okay, you have to have a perfect storm to generate. Like, you remember, think back to like Japan, right? When the imperial, the land underneath the imperial palace was valued more highly than the state of California, right? At that time, the Nikkei was trading at a slightly higher level than it was today, and that was 1989 or 88, 89. I believe the top was 41,000. Okay, you go back to that. At that point, the Nikkei was 39% of global market capitalization. Now, the U.S. economy's, yeah, the U.S. economy.
I thought it was higher than that, actually.
No,
Sorry.
no. Now, but when you think about the size of Japan, that was still insane,
Sure.
right?
Yeah,
I mean, But then you put it in perspective, probably the biggest bubble. And then you've got to remember the Nikkei at that level was at like 100 CAPE, something like that. I think it reached like 104 CAPE, the cyclically adjusted PE, right? I think the US markets are like 33, 34 right now, which is obscene. Okay, so now people are like, well, we could go do the same thing. I don't think so. And the reason I don't think so is because of the size of Japan, meaning every investor wanted a piece of Japan, and it's a much smaller market. So naturally you had, way less constraints to the upside on valuation. My point though is to get to that level of saturation in a market, and then at the same time to go look at the performance of other international markets over the same time. They went nowhere. They went sideways. A story I tell people, we are in the process. We've been trying to accumulate for our clients. And again, we're not really big. The portfolio that I'm talking about that we run here is about 500 million. Okay. So in a $500 million portfolio, we're trying to get an equity position in Greece. We've been working on it for 2 months. We've got a 0.7% portfolio weight in there because it's so thin. So what you start doing, you start looking around the world, there's no money in these markets, man. None.
Right.
And all of a sudden now, you've got a little unraveling. To what degree, we're going to find out. But you have somewhat a reversal out of this globalization move, which requires countries to repatriate some of their capital. And so every arrow was pointing to U.S. markets for so many years. I'm not saying every arrow is pointing away, but every arrow is no longer pointing at U.S. markets. So one of our beliefs are that I think you could have certainly a period of time where at the very least the S&P underperforms international markets, just as a symptom of it becoming kind of the funding mechanism for everybody, everywhere else. If you're a fundamental investor, the valuations you can find abroad are mind-numbing, especially compared to here in the U.S. And so, but I do think, I do, to get back to your original question, I do think we're at a scenario here where at the very least, the complete dominant outperformance of the S&P is like I said, at the very least going to take a break. And if not, be over, because again, when you start looking at these valuation spreads, here's another thing. Very few countries in the world have done what we have done on a balance sheet basis over the last 15 years. Right. So you look over at Germany. Germany's at what, 63% debt to GDP, and they're talking about they're going to do fiscal, right? Yeah. So now we're in a situation where we've got to pull back on the reins, or at least attempt to. So I just think you're seeing a lot of these arrows that for 15 years were just pointed at the U.S. And I think that the U.S. right now, out of 40 of the top performing markets in the world, the U.S. is like 36th. Right. So it's getting outperformed by 35, 36 different markets internationally, and by big numbers, 20, 25, 30, 40%. And then you go look at these markets are still trading at less than 10 times earnings. Right. So anyway, I do think that the absolute dominance of the S&P is over for at least a while. That's our belief.
Your interest in Greece, that's interesting to me. That's one I haven't thought of or heard of. And I've heard, I was at a macro conference last week, and one of the ideas that got brought up, obviously, Latin American and South American countries, huge interest, people like, and I alone, I have been managing my own retirement, and I've allocated a bunch of money towards Colombia, and thinking about Chile as well. One that I really caught my attention, and I was like, well, that seems like this is genius, is Vietnam. And if you look at that Vietnam ETF fund, I think I can't remember what it's, VNM maybe is the ticker. Don't quote me on that. But it's of all the conversation about, maybe Vietnam having a lot of the allocation from the Chinese manufacturing and moving that to Vietnam, and it has happened over the last couple of years, that chart doesn't look great, to the point where it's maybe there's an opportunity in there.
Vietnam has been something that's really interesting to us, and we don't have a position on it right now.
Either do I.
Would say I would say that it's in our AA farm team right now, right? It's not quite a AAA yet. We're not ready, but we're keeping a close eye on it, right?
Yeah.
It's in the minors for us. We're trying to develop it. In a couple different ideas. First of all, Vietnam's not a very large country, and so I think you've got a dynamic in that country where they have obviously already been the beneficiary of significant levels of offshoring coming out of China. I think that will continue to persist. But due to the fact that they're a small country, I think you could have a scenario where the standard of living continues to rise very quickly there, which in that scenario, you want to own bonds, right? I know this sounds crazy, but one of the, and you probably remember that, I'm sure you remember this, one of the great ways to generate some alpha, and I'm thinking back to the 90s, early 2000s, was when you had these currency issues, right, around the world. And this time it's a little bit different, because I don't think it's going to be their currency issue that drives it. I think it's the fact that the dollar has been so high against these currencies for so long. It's beaten a lot of nonsense out of those economies, out of those markets. I think it's constrained government spending to certain degrees. And so you've got this scenario now where, like I said, I think you're going to continue to see upward pressure in those economies, but I think there's going to be phenomenal opportunities to step in there, sort of like buying emerging market debt after the Asian currency crisis, right? Mm-hmm. But it's playing a little bit different. I think that dominant period of the dollar, I think the top is in on the dollar. And I don't mean that we're looking at imminent collapse, but I expect to see a DXY trade down into the 80s at some point over the next few years. I would be shocked if that wasn't the case. And in a scenario like that, emerging markets are going to go absolutely ballistic. They also look at the relatively low cost of commodities. Everything an emerging market needs right now, the dollar's getting cheaper, commodities are already cheap. I mean, it's nirvana for those guys. So I think I know for a fact there's got to be a lot of really, really compelling investments there. The chart looks bad. That has kind of stayed our hand. But like I said, it's in the AA and it shows some real promise. It could be a starter for us at the big leagues at some point.
Yeah. Sitting with the capital that you do manage, Zach, obviously the move in gold can't go unnoticed. And I know you watch it quite frequently here. With the general kind of capital management scenario, just from your seat, what's kind of been the conversation with clients regarding allocation to gold? Is it something that, once you see something like that, once those conversations start happening, you're like, okay, maybe a relatively recent top is in? Or were you starting to have those conversations before this big run up to, before we petered out at 3,500?
We were kind of, gold is something that probably much like you, If I think back to 2019, 2018, I don't think we owned any gold miners. And the reason for that is not what I believe is responsible portfolio construction. The reason for that, right or wrong, is my my familiarity with the gold mining industry. Meaning, I think all of us that have been around the gold mining industry have a feel for when the time is right. Don't necessarily top tick or bottom tick things, but I just didn't see the impetus to drive gold at that point. People are like, what do you mean? And I'm like, I see 3% growth in the United States with 1.5 to 2% inflation. The rest of the world not growing. Yes, we're running a lot of debts, but the DXY is at 105. It's probably not an environment where gold is going to do extraordinarily well. But it was something that we've all known. As you watch that debt cross 100% to GDP, you watch $1 trillion. I'm old enough to remember when our debt reached $1 trillion, right? Now we're talking about throwing on $1 trillion over the course of 4 or 5 months,
right.
Which is just mind-boggling. And so we've been talking to our clients for a long time, kind of laying the ground for that, right? Tilling the field and getting them ready to see gold in the portfolio. And then honestly, we've had a position in it ever since the Fed announced the actions they were going to take in COVID. So we haven't had the same position size the entire time. But that was when I remember specifically that day, jumping back in it in a pretty urgent fashion. And now, you look back and you're like, I should have even bought more. But I want to say that day we were buying the GDX at like 18, something like that, 18, 19. And so we've been talking a lot about that to them, talking about the history of gold, the historical performance of gold. And then also, it's not fun to have everybody looks back on a value stock scenario, and when it's said and done and it pays, it turns out everybody's like, yeah, that was the smart play. That's what I'm going to do next time, right? And everybody forgets the pain of owning a non-appreciating asset in a market that just keeps going up. It's brutal, especially when you're in a competitive world and trying to generate performance and all that kind of stuff. But like I said, you get to a point where, you and I have talked about this before, but you're going to see mining companies, you're going to see major mining companies throwing off 60% plus margins, right? Like it's just ridiculous. It's stuff that we never would have even thought about. And like I said, we just kind of laid that story out to them. I'm sure we have lost a few clients from that because, probably not many though, because I think a lot of those clients have heard us talk extensively and come to us because there's sort of a philosophical match to some degree. And I think that anybody that has a basic understanding of history could have probably seen why it may not be a bad idea to hold 3 or 5% in gold in a portfolio. But it is really hated. And if you look at the performance of gold, and I haven't looked at it recently, but my suspicion is with this latest run up, it's probably outperformed the S&P since 2000. Do you know those numbers?
No, not. I mean, it has significantly outperformed, but I don't know the exact numbers. It absolutely has, though. I've seen it.
And think about that. You want to talk about like the least known story out there, right? It's a pet rock. It's worthless. It's horrible. You got to ride the S&P 500. The shock on people's faces when you tell them that, right? Yeah. And we're talking 25 years, right? 2000, the age of big tech. I bet you it's performed pretty on a commensurate level now to probably the triple Qs over that period of time. So anyway, our clients were kind of predisposed that way, but you look back historically, and I think I'd flip around and look at these anti-gold guys and go, why don't you give me an analytical case to show me why a 3 to 5% allocation to gold inside of a portfolio isn't a good idea?
Right. I did put out some numbers last week in a presentation I gave at a conference. I think it was over the last 20 years. I'd have to pull back the notes here, but gold appreciated 700%, while the GDX only appreciated 35. So that's where we're at. today. I know.
Well, hey,
It's
look,
brutal.
and I mean, you and I both know the valuations reflect that. And like I said,
Right.
I don't think there's ever been a harder time in history, at least in my career, to buy things that nobody likes because we've sat there and seen them sit for years. But I just think at some point you got to go, look, when I see a mining company that is making operational improvements and making progress, they face challenges, right? But I see their stock fall 40% with no real reason, just some reorganization things here. But I see their stock fall 40% while gold goes from 2,000 to 3,500. And I know that these guys have got massive amounts of really high quality reserves. That's absurd, right? That price is wrong, period. And so I think that's where you're at on so many of these things.
The last kind of theme I thought would be kind of fun for you and I to have, Zach, is I don't find it ironic that the Oracle of Omaha announced his retirement in this kind of cycle we're in. I think he's an incredible run. I think this is more emblematic of maybe him setting aside. I know he's 94, but I think it's emblematic of the cycle kind of coming to a top. And so Warren Buffett announced his retirement, and I was kind of looking in and out of the Berkshire meeting last weekend, and I pulled up a couple of quotes he said that I thought were really meaningful. And I thought it'd be kind of fun for you and I to kind of go back and talk about this a little bit. Yeah. And he said, quote, "Obviously, we wouldn't want to be owning anything that we thought was a currency that was really going to hell." He added that large foreign investments might require financing in local currencies. So this goes back to this repatriation of capital outside of the U.S. coming back home that you and I have just had, and we've had a couple conversations there. The other one regarding the $1 trillion of debt we put on every quarter, seems like he said, "Fiscal policy is what scares me in the United States." He warned that the current deficit path is, quote, "unsustainable over a very long period of time," end quote.
Yeah.
I mean, again, it's not above me to think of the big picture of him stepping away and also seeing where we are at in this cycle. You know what I'm saying?
Yeah. I would love to talk to that guy for so many reasons privately, but I would love to get his thoughts, without anybody else. I guarantee you he's going to speak differently if he knows no microphones on. And it's something I respect a lot about him. I think he understands that he has a big sway in markets and doesn't want to be, quote unquote, putting his fingers on the scale. But, the other thing is, look at that cat. I think he's sitting on $380 billion in cash now too.
It's crazy. Yeah.
Just nuts. And this is a guy that doesn't like cash, right? Now he's been cashed up pretty big multiple times over the last 10 years. So you can't just jump on that. But it wasn't $380 billion. And I think that is just so reflective. I think that not enough people have asked, why did he slash his Apple holdings by 80%? And I like I said, I think I would also be surprised if he's made other comments recently in the last 2 years saying that he has never seen the markets behave more like a casino than they do today. Yeah. And I don't say this. I mean, the guy's 94, like you said, he's had a run like no other. I would think that a part of this is just kind of also throwing up his hands, no longer wanting to fight against all of this insanity. I think there's a part of it that is probably capitulation to him on some level, because I am not at all equating myself with Warren Buffett. But when you look at the world through a fundamental lens and believe things like fundamentals and cash flows matter, this market can be enraging. You know what I mean? Like it just, it can be confounding at times. And I know that guy is he and Munger were just the picture of being unemotional and staying steady. But the insanity of the way this market moves, it wears on you. And, the idiocy of it is exhausting. I bring up a Carvana. Like, no, I'm serious. If you want a laugh, you got to go read through that queue. Okay, so one of the reasons that their defaults, now think about this. One of the reasons that they're not concerned with their credit book, which is just a flaming pile of garbage, okay, is because their defaults are low because they've been extending car loans. Car loans. Now, think about car loans are pretty uniform in term for a very specific reason. Meaning, after you get beyond 5 or 6 years, there's no asset value left, right? So when your default rate is staying in line because you're not even arbitrary, but you're extending loans, and that makes your stock go up 11.5% at those valuations. I mean, you can't make this stuff up. So I got to assume that there's probably a bit of exhaustion in it too, and just, saying, to heck with this. I think there's probably also, I would think, and I think you could see this reflected in some of the moves in the smaller amounts that the other guys managed. Was it Todd Combs and then Greg Abel? I think they both ran side books. Mm-hmm. If I remember correctly, I think they both managed like 5 or 6 billion or something like that. I think Buffett might also be acknowledging that he needs to take a slightly different approach. I mean, let's face it, markets move and information travels in a much different, in so much faster way than when Buffett made his mark. And I do think the basic tenets of the way in which they invested, I still ascribe to them and I believe in them wholeheartedly, but I do think that you have to move differently now. I think that you have to move faster. I think before you could build a position over time, and sometimes now you got to just jump. But no, it's the end of an era, and I really hope that he's got good time left. But part of you also wonders, I don't know how that guy's going to keep his hands out of the. You know what I mean?
Yeah, I hear you. I hear you. It will be interesting to see if the institution does somehow change its strategy of allocation moving forward. But there's one more quote here, and I think this is also, we'll wrap it up here, Zach. But when we ask ourselves, all right, did we find the bottom in the market, or can it go lower? Speaking of all the cash he has, the 300 billion or whatever, he said Berkshire will increase its earning power over time as we retain money, which they've done. They will make their best deals when people are the most pessimistic. They are not out there doing deals right now.
Yep.
So I think we're in the middle of it. It hasn't popped. It hasn't, we're not suffering yet.
No. And I think that there's really easy telltale signs. And Buffett and Munger both talked about these things at length in the past. I think there's telltale signs. When you see action in like a stock like Carvana, you're not there yet. When you see the Palantirs of the world, trading at 90 times sales, 100 times sales, growing 35% a year, you're not there yet. The interesting thing though, and you pointed this out earlier, those things are ripping. They're not at their highs though. They haven't broken into new high territory. I got a feeling, Trevor, that the high that we saw earlier here this year in the U.S., I think that there is a much higher possibility than most market participants would say, in that being a more durable top. Now, I get it. I wouldn't be surprised to see us trade in a range with that being the top and the levels we were at just a month ago being the bottom. Range trading sideways for a long time. Yeah. But at the same time, I've seen a lot of ridiculous stuff in this market, and I wouldn't put anything off the realm or out of the realm of possibility.
Yeah. All right. Zach, appreciate you. It's good to have you on this podcast, and I always enjoy our conversations, whether it's on mic or, over a meal. It's always fun. Give us before we let you go, tell people where they can find you and your work.
Yeah, well, and I'm going to hold you to it. We're going to get you on my show, and we're going to dig into the deeper space of the miners and kind of roll up our sleeves and get our hands in the dirt. But yeah, so we do a daily podcast. We do like a market wrap, discuss all the important political and economic news and market news that came out that day. You can get us on YouTube at Know Your Risk Podcast. You can go to knowyourriskradio.com and subscribe to the podcast. You can find us on Instagram, TikTok, Twitter, on Twitter at KYR Radio. Not too hard to find. Google Bulwark Capital Management. And yeah, man, thanks for having me. Fun as always, and looking forward to getting you on and digging through some dirt.
Yeah, Zach, thanks so much. And everybody listening, don't go away. Honestly, we got another segment here. I missed last week, so I feel bad. We're going to go an extra long episode here this week. We're going to actually turn and talk about agriculture with Damian Mason here in just a quick, short break, so do stay tuned. Zach, we'll talk to you again soon.
Thanks for having me.
All right, everybody. With our second segment here on Friday's Long Form, we are going to take a step away from the mining markets and talk about agriculture. This is something we haven't done it in a while. Actually, a couple of years ago during COVID and the market reactions to ag products coming out of the Russia invasion of Ukraine. I think that was about the last time we actually talked about agriculture, but I think it's important for everybody to kind of get a grasp of. And it's something that's important to me. I'm trying to get better handle of, being from a Midwest kid myself. This is something that I used to follow somewhat regularly and have stopped, but now I'm really finding a lot more interest into it. I'm happy to welcome in Damian Mason. He runs a business and a great podcast called The Business of Agriculture. In fact, it's so good. Back in the fall, I reached out to Damian as when we were launching the Clear Commodity Network, and I asked him if it would be possible to syndicate the Business of Agriculture podcast on our channel, on that network as well, at clearcommodity.net. And so this is the first time Damian and I have actually spoken in person. So Damian, it's a real pleasure to meet you.
Thanks for having me on here. I appreciate it, Trevor. You know, I saw your stuff and I said, okay, what's this all about? And then I checked you out. So you checked out. You passed the BS meter way back when we began doing that. Remember, I've got, you get to a point where after 8 years and having the Business of Agriculture show, getting a decent following because I think I've got good clientele and whatnot. Then you get solicitations, I'm sure you do as well. Foreigners that want to make you more famous than Bob Hope and whatever, and then they're always sending you crap and telling you how they can make you a star in Bali. I don't know, that kind of thing. So
I get a lot of people wanting me to promote their really bad exploration moose pasture project. That's kind of the world I live in anymore on the mining side. But
yeah, and there's always somebody that they think that you can do something for them. And they position it always as, well, this could be really good for you. And then I always say, how in the hell? I mean, if you really believe that, that's a problem because you're not thinking through this. If you're just lying to me, how would this be good? How would me doing this be good for me? But yes, there's a lot of that goes on in this space.
Yeah.
But not to be hijacking the subject here. The good thing about the internet and this YouTube and Riverside and all these things that you and I do, and Zoom, etc., is it's given guys like you and me a lot of opportunity to reach people that we're kind of in our audience, but we had to work harder at it. And so that's a good thing where we are right now in terms of this.
Yeah, I will say I'm absolutely grateful for what this has given me, a career and, just wonderful opportunities, a lot of travel, meet wonderful people. Anyways, Damon, I'm sure you feel the same. But let's get to the topic at hand. I do want to talk to you about agriculture. We kind of come at it from a markets perspective. We like to watch price action. The things I'm noticing the most, the big themes out of the ag space, grains in the tank, but the ranchers seem to be doing well. The cattle prices are continuing to run at an all-time high. I know you don't necessarily dig straight into the price action. You're kind of big theme, big picture of the business of agriculture, obviously. And so I just wanted to kind of pick your brain a little bit. Like, what are those major themes right now? If you're talking about American farm productivity, what are the major challenges they're faced with right now, but also what's the wind to their sails look like, if anything?
Yeah, well, your people are, as you said, you're in the mineral and mining space. So let's go straight to the one thing that is very good for agriculture. Our equity position is generally very good in terms of if you hold assets, if you hold agricultural assets, if you hold agricultural assets, particularly being real estate. Gold and farm ground tend to have a similar situation where when there's uncertainty, when there's fear, when there's a little bit of blood in the water, more importantly, even if there's not real blood in the water, if there's the fear that blood is coming to the water, there's always a flight to safety. A flight to safety includes things like gold, silver, hard assets, and then also real estate, particularly agricultural real estate, which we always say has a roughly 1-to-1 ratio to inflation. So it's a pure inflation hedge. And I'm not talking about maybe, and I get picked on by my friends that are in these areas, but if you're in the panhandle of Texas where they get 8 inches of precipitation, that's not necessarily as unvolatile. But when you're talking about mid-Nebraska to mid-Ohio, where we get precipitation and we tend to have real soils that can be productive without the need of irrigation, that's a good situation. So farm ground is still held up. We're talking about commodity prices being down. Brooke Rollins, Secretary of Agriculture, is even discussing how we're going to probably be tossing some money at farmers because of depressed commodity prices. The asset position tends to still be pretty good out here in most of it. I can't speak for almond property in California. That's a different thing because of the water contingency, environmental pressure, and some environmental and regulatory issues. So that's a good thing. Where's the struggle? Right now, your base commodities, the corn, the soy, and the wheat. Corn's above profitable, but not by much. That's why we're going to probably plant the most corn in the United States of America in 2025 as has ever been planted. We might come damn close to 100 million acres. To put that in perspective, normally we're around 90. So, you're saying, well, from 90 to 100 doesn't seem like much. Well, take anything else and put 10% more on it, right? So We're talking 96 million acres of corn. Soybeans are going to be largely produced at the cost of production or below the cost of production, depending on what your real estate is valued at. A friend in Iowa, farming $12,000 per acre farm ground, can't make soybeans pencil out. Maybe if you're in the South where you're farming $5,000 an acre and you get a similar yield, you just have to use more inputs because it's not quite as good of soil. You have to pay for irrigation. So anyway, the point is we're in a real oversupply situation. A lot of people get this wrong, Trev, and they say, oh, it's because of the problem with China. Remember, mostly when you hear that, that is bullshit. It is because of an oversupply. If China's not buying U.S. soybeans, they're buying them somewhere. The people are not going without eating. So it's usually a global oversupply situation. So we're globally oversupplied. Soy and wheat, the main commodities. Beef's a real bright spot. Dairy's a bright spot. Pork is starting to make a little bit of money. Sugar is at break even. Cotton is below break even. So there's just the big story I would tell you is, with the exception of eggs and beef, we're generally oversupplied with about everything that we need globally for agricultural production.
So if we have an oversupply, if we stick with corn, if we have an oversupply of corn that we're faced with, why increase the production another 10%?
Because that's less oversupplied. Because there's still a profit margin.
Okay.
Because there's still a profit margin. And also, remember, that's incumbent upon or predicated on, in the United States, we take about 40% of the corn that we produce and we run it into an ethanol plant and turn it into fuel that we burn up in our gas tank. So corn is less oversupplied because we have invented demand through legislation 20 years ago, the renewable fuels standard. Were it not for the fact that 40% of the corn, because they're required to do so with the renewable fuel standard, goes to your gas tank, we'd be so glutted in corn you'd be buying it to, let your kids play with it instead of sand in a sandbox.
Oh, interesting. That's a conversation we have not had, that ethanol conversation. Productivity.
That's the minerals and mining. Let's talk about it.
Yeah, let's talk about it. 40% of corn production goes into the chemistry of producing ethanol. What is the demand, the supply and demand of ethanol? Now we're facing, $57 a barrel of oil. How is that kind of balancing out on the traditional oil patch?
So I'm not a commodities expert. I always point that out. I do have a degree
Sure.
in agricultural economics. There's people that stare all day long at commodities graphs. If that was my life and I had to get excited about a 3-cent move in the soybean complex, I'd take the handgun out of my shelf right here and I'd do something bad to myself because that makes me nuts. I'm not a commodities expert. So anybody that out there that is, feel free to correct me. You will not hurt my feelings. I'm a marketplace guy, not a markets guy, as my friend Trevor already pointed out. So what I can tell you is this. Ethanol makes sense because the government required it to happen 20 years ago with the Renewable Fuels Act, which created the Renewable Fuels Standard. Last year, when I say 40% of the corn crop goes into ethanol, remember, that's not a fixed number. There's a fixed amount of corn that has to go into ethanol. There's a certain amount of blend that has to happen. It happens to be that usually has equated to around 38 to 40%, 36 to 40% of the corn crop. If we have 96 million acres of corn this year, whereas last year we only maybe had 91, clearly it may change the percentage because we'll be producing more corn. Why do we have ethanol? We have ethanol because we had too much corn. We've had too much corn since the 80s, frankly. And then we invented this thing 20 years ago to burn up our corn because it's our number one crop in the United States, and we're the number one producer of corn globally, although our degree of number one-ness has decreased because other countries got in on the corn party also. China's like the number 2 corn producer now. Brazil's obviously ramped up corn production, etc. About 11% of all the gasoline burned in the United States is ethanol, okay? So the blend is going to move upward. Now, the Trump administration is talking about making it so that it's not just seasonal, that you can require it all year long, which is going to be positive for corn ethanol. And that's probably because they're saying we got to do what we can to bolster the ag sector. Remember when when oil is too cheap, if you were talking about oil being at $40 a barrel, it costs you money to make ethanol, right? So even with incentives and the rule requiring it, if oil is too cheap all day long, we should economically burn the cheap oil, right? So oil needs to be at a certain price point to then justify its substitute or its supplement, which is what ethanol really is. Now, where that number is, again, you've got a markets expert listening to this, Trev, that's going to say, that number, Damian, is this. And I don't know that number. Call it $65 or something like that. Don't quote me.
Okay. All right. Very good. I do want to ask you about soybeans and also pork, because obviously, and you mentioned a few minutes ago that you called the China narrative kind of BS. But from an outsider, just kind of maybe who's, novice kind of looking in, we assume, soybeans, pork, those exports into China mean something. Those are important. But where does this dynamic fit as we currently with these trade, whatever, if you want to call them negotiations or talk, whatever they are right now, how have soybeans and pork been impacted with these geopolitical tensions between the two countries?
So far, almost not at all, because China, I just was looking at this article from people who are market analysis people every day. We don't deliver a lot of soybeans. You and I are recording this in May of 2025. In May of 2025, soybeans are going in the ground, or in the South have been in the ground for a month, let's say. We don't sell a lot of soybeans now. We sell a hell of a lot deliver a lot of soybeans somewhere between September and December. So the reality is the trade spat has been in place now for 4 to 8 weeks. So we haven't really lost out on sales, because a lot of it, if it was haggling. It was some politician saying we're not going to buy. But in terms of the actual deliveries, hasn't really changed much. Pork, well, remember that one of the big pork processors in the United States, Smithfield, is actually Chinese controlled. So is pork still going to China? Yes. Has it really been impacted by the trade war? No, not yet, because the trade war really hasn't taken off. It's been haggling, it's been negotiating, it's been spatting, but we're not really in the depths of it yet. If there really is a big, huge tariff on China, then they can pull back and not take pork, but it hasn't really materialized yet. On soybeans, it's important long-term for agriculture, because I believe that soybeans represent almost 10% of the value of all American exports to China. So that's the one thing where they can hurt us, and that's why they always do when we get into a trade spat. They say we're not going to buy American soybeans. From a standpoint of the rest of the ball of wax, I think that, and my numbers are close but not exact. Soybeans represent something like 25% of all agricultural exports to China. So that's a real big spot for us, is using, because they use them in their hog trade. Remember, China produces, grows, farms about half of the world's pork, and they don't export a pound of it because it's their chosen protein. They've got a country that's now more rich than they were 20 years ago because of manufacturing and industrialization. So now a Chinese factory worker can eat better than their parents did. Literally, they're eating higher on the hog and more hog. So all those soybeans go to China and get turned into pork.
Interesting. So if there were to be more upheaval in trade, if there was official trade war between the two, would China potentially look to the likes of Brazil to kind of fill that pork demand?
Okay. Yeah, I mean soybean demand, which they already have. So they've been, and this is why I tell my ag people that this is what happens in every industry, Trev. People that work in the industry get very focused, and the world becomes the size of their thumbnail, and they know what happens right in their little world. And so the soybean producer from Iowa might say, well, we got to have China, and China's going to just go somewhere else. I said, they were already doing that. Brazil has produced more soybeans than us for the last several years. Brazil is a better soybean producer than us in terms of quantity than we are. Am I bashing on the American farmer? No, I'm just saying they have literally entered millions upon millions of new acres into soybean production, and they have millions of more acres to do so. More importantly, China never wanted to be dependent on the U.S. to begin with. China wanted to have a country they could control to exploit their resources and agricultural output for their own security. Brazil fits the picture. You could argue that China installed Lula, the president of Brazil. It has a lot of similarities to another story you might have heard. They grabbed a career politician who's a little bit crooked, actually criminal, senile, threw a lot of money and influence and created a lot of propaganda, got him elected. A lot of folks on the other side said this election looks rigged. They stormed the presidential palace. I don't know if any of this story has any similar overtones to anything you may have heard in the United States. But anyway, that's what happened in Brazil. So arguably, China has set up Brazil as a satellite. And so that's going to continue. So trade spat or no trade spat, China was steering around the United States for their soybean security, their soybean supply that they need long before Donald Trump. This has been going on since Donald Trump even came down the escalator in 2016. True story.
Yeah,
now, did the trade war intensify that and make China decide, yep, by God, for sure, we need to have other soybean suppliers? Yeah. But it was happening anyhow.
I want to ask you about U.S. farmland and just the valuations on this. You mentioned it kind of the beginning of the conversation here, Damian. But you did an interview a couple months ago talking about, a little bit about the valuation of farmland. And you asked the question, you had two guests, and you asked these questions about, is farmland overvalued? Is U.S. farmland overvalued? But you also said as inflation rises, the valuations of farmland continues to rise with it. And so obviously we understand that we're still in a rising inflationary environment. It hasn't necessarily subsided. Yep. But who is buying farmland? Does this continue to be big conglomerate type operations? Do the mom and pop farmers, that I remember growing up with in small town Nebraska, do those people still exist, or are they getting dwindled down piece by piece, farm by farm?
Depends on three things: where you are, who you talk to, and what you define as mom and pop. Many of the buyers are still farmers. Does it look like Ma and Pa Kettle? Does it look like American Gothic? Is it farmers that live on 40 acres in an old unair-conditioned house and go out and work with their bib overalls? No, but a farmer that is a buyer might also be what the media calls a corporate farmer, meaning they have 17 employees. They farm 17,000 acres. They have a hog facility on a contractual arrangement. They've got 2 kids that are working in the business, and they own a substantial amount of agricultural business operation. So farmers, whether it's what the media would call corporate farmers or whoever it is, are still buying a lot of this farm ground because there's still a lot of cash on the sidelines. Remember also, farm people like farm ground. You give a farmer and maybe I'm even included because I came back to my hometown and bought farm ground, and I'm not even a farmer, but I was raised there. You give a farmer $1 million, they'll usually figure out a way to put a bunch of that into farm ground. Versus if you said, yeah, there's three other asset classes you could put this into, and they're going to go and put it into farm ground. So there's that. Institutions are in the game. Remember, there's a lot of acres of farm land, so you might hear that an institution or an investor group bought a 640-acre chunk of ground, and that sounds big, but remember, there's still a lot of acres out there that are not held that way. Did pension funds hop in? Pension funds and those kinds of things? A little bit. I've seen a little bit more where there are some investor groups, like you say, hey, and one of the new things that happened, Trev, is I can't give you $1 million right now, but I can give you $20,000 a year. And so there are entities that are doing a thing where you can acre trader and these kinds of things where we're going to buy this chunk of farm ground in Minnesota. It's $1 million. We're looking for $800,000, and then boom, you kick in yours and somebody else, and then you actually it's almost like a mutual fund of farmland ownership. A little harder to get out of because they don't want people coming in and saying, I want to sell my share tomorrow. So usually they're fixed in like you can't get out until after 7 years or something like this.
Has private equity found its way into farm operations?
Somewhat. The tough part is they will fund you, but they generally don't want to hold all the assets. So there are equity groups that want to own farmland, but they're not doing it at scale. And this is one of the tough things. A lot of folks, Trev, we've heard my whole career, I'm 55 years old. Well, big money, big money, big money. And I kind of started pointing out, so I said, I know big money. I didn't when I was a kid, when I was poor, but I've gotten to where now I work in a lot of different circles. And I know people that have $100 million to invest, or them and their three business associates. They wouldn't settle for the kinds of returns that we settle for in commodities. In mining and in agriculture, you historically have boatloads of capital deployed to make single-digit percentage margins. I know people that are big capital types, they don't want to put their money at play unless they can maybe make 18 to 21%. There's no such thing as a 20% return in production agriculture.
Really? Okay. So if we talk about maybe general, like a commodity cycle, like in mining, we always go back to the commodity cycle, early 2000s with an abrupt end in 2011, right? And you and I obviously come from different spaces in that commodity sector, which is why I appreciate everything that you do, because it gives me a breath of, something to follow and learn.
It's
a little different.
Different avenue.
But so a lot of us in the metals space, we're like, oh, maybe this is the next big commodity cycle, just to have the rug pulled underneath us for the last couple of years. But this feels pretty interesting here, because we've had, at least in the gold space, we've had elevated gold prices while the rest of the base metal complex, other than copper, really is kind of hindered. That's really a supply issue as well, productivity coming out of China and Indonesia and a lot of other spaces. Copper is a little bit of a different beast, but the gold space is telling us one thing while the base metals complex is telling us a little bit something different. So it's almost like we have similar narratives in each industry, but what is the signal? Like, Damian, what's the sign that you're going to be looking for when you're start really thinking I think this cycle is back. I think we've got a long way to run here.
Well, I'm not sure I'm going to be seeing that cycle for a while, because I believe the trend toward oversupply and stagnating demand is here for a while. And I'll get into that in a second. Before I do, I want to give you a thought from an agriculture perspective. I told you when you opened the show that there was a bright spot in farmland as an asset holding its value, and that's still a good equity position for many farmland owners. Even if you're going to break even this year on your farm. Now, the problem is a lot of farmers love farming so much, they'll eat into their current assets, and then they'll also start eating into their permanent assets, and all of a sudden they've leveraged against their farmland for 3 years so they can keep farming until they've whittled away their position to where, finally somebody like you and me says, well, okay, we'll buy that piece of farm ground, and it's already, they're upside down and backwards. But remember, farmland and gold are a different thing, because again, if you're buying a chunk of farm ground, even right now with a little bit of weakening. Let's say University of Illinois says we're down 6% from where we were as our high. Let's say you are down 6%. Even buying at 6%, if you paid cash for the asset, no mortgage at all on a piece of farm ground, you're still probably talking about a 2.5% return of actual net return. Now, what you hope for is that you can make more off of it 10 years from now, cash rent, as you can right now, renting it to a farmer, and you hope for appreciation. But if we're at an all-time high, how much appreciation is there? It doesn't necessarily make sense. But remember, it's a psyche. It's a safety. It is a security. It is I want to have something hard and tangible. Gold's the same situation. You can tell somebody, hey, $3,500 an ounce gold. I don't know what it is right now. You're the expert. I'm not sure there's a lot of upside on that. Whereas copper, I can use copper to make pipe. I can use copper, there's gold doesn't have a purpose other than a flight to safety as an asset. So you can argue about the psychology of that. And farm ground has a value and is rentable, but the owners of it will tolerate very, very low returns, even cash on cash. So anyway, that's it. Back to the cycle. My peers don't like to hear it, but I point out that all we really were doing is returning to the 80s when we were completely oversupplied. There was inflationary pressure, world squabble, some trade disputes, and arguably higher interest rates. Right. And folks say, yeah, but in the 80s we had 18% interest. Now we're only like at 7 or 8. I say, okay, we'll do a comparative. We were at 2.9. So you're arguably up 2 to 2.5 times from where we were. 2.5 times from where we were. When interest rates were in the 18% range in the mid 80s, when the farm crisis was on, they were also up about 2.5 times. So on a percentage of increase, I can make the comparison today, Trev, to the 1980s and say, don't use the nominal number, use the differential between what it was and what it went to, right? Mm-hmm. If interest rates today are 2.3 times what they were 4 years ago, you could make the same case in the 80s when they were at 18%, having gone there from 8, okay? Right. Oversupply, we were glutted with so many things in the 80s because the 70s were big, and we said farm to fence row to fence row. So in terms of, is the cycle going to improve? Beef still looks good. The consumer still is somehow eating steak, even though it's $16 a pound. Beef is in a very low inventory situation. And eggs, because of avian influenza. That's why you're paying $6 a dozen of eggs at Kroger's just a couple of months ago, because we were in a low inventory situation. The rest of the market, if we stay in a situation of producing a lot, which we are, and the rest of the countries feel like they have to produce a lot because there's a trade war, and when there's a trade war going on, you say, oh, well, let's not produce as much because we have nowhere to ship it. The inverse usually happens, Trev. Nationalism kicks in, and you say, holy shit, we might not be able to buy soybeans, so we better make all of them that we can because there's a trade war going on. So what happens usually in trade wars is surpluses start piling up because production ramps up under the uncertainty, which is really silly. So all of a sudden, like if you think, oh my gosh, China's never going to sell us drywall, we'll never be able to build a house. There's one place that makes drywall in, I don't know, Alabama. Quadruple it. And next thing you know, a few years later, you've got more drywall coming out of Alabama. That's my point, is that usually trade wars distort things first, and then they actually create more supply because of the uncertainty.
Your discussion
it's not even
about
necessarily because they're not being sold, it's because it's what happened in the 80s after the grain embargo. A bunch of other countries said, we better make more grain if the United States is going to start trying to hold us over a barrel.
Your discussion about the 80s hits home. A lot of people who have been longtime listeners of this will know the story. My family came from a dairy farm, and we lost the farm when I was like 1 year old. So I don't much remember it, but we lost the farm because it's a terrible time.
It was a terrible time, and it happened in a lot of places. Obviously, I'm from Indiana, and we were on a shoestring budget. We were not generational wealth. My grandfather came to this country and milked cows for other people as a herdsman. We had, my mom and dad, we were on the first farm owned by a Mason in Indiana, and we made it through, but a lot of them did not. And so again, your people are in the mining and mineral space. When you are in commodity production, there is the cycle, there is overproduction, than there is rampant demand, etc. And where we both, or your listeners and my people have a similarity is we've always then caught our breath during the downturn and ramped up for the new demand. And this is something that is completely comparable in your world and mine. What if the new demand looks like it does right now and never gets better? And that's going to be because of demographics. And I've been preaching this for 11 years to my audiences, and they all thought I was crazy. Declining demand will happen. Population is going to stagnate and then it will begin to decline. Our Social Security, our social welfare system, our economy, our home building, our agriculture, and our commodities, and about every production business that we have has been predicated, Trev, on more mouths, more humans, more need, more buying next year than there was this year. Oh, well, maybe not next year because there's going to be a recession. Okay. Generally, the trend line is up. What if we are where we're going to always be in terms of demand? And that's a real tough thing for everybody to get their hands around. In other words, what if we don't ever need ever again more stuff? We need less stuff each year moving forward. And that day is going to come probably another 10 years where all of a sudden we just start to decline.
Yeah. Damian, I'm really glad we had this conversation. I'm glad you gave us some of your time because, again, it's fantastic conversations you have on your channel. I appreciate everything you do, and it's nice to come back to a little bit to my roots that I grew up in and get a little bit more perspective on something I don't necessarily follow much anymore. Obviously, anybody interested in Damian's work, you can listen to the podcast. It is syndicated over at clearcommodity.net, but Damian, where can everybody else find you and maybe follow up with any questions they might have?
Yeah, well, find it at clearcommodity.net. The Damian Mason YouTube channel. Just go on YouTube, type in Damian Mason, DamianMason.com. I'm all out there on social media. Well, the thing is, the commodity space, mining, mineral, agriculture, they walk down the same aisle together in so many ways. And a lot of people, we make the connection as markets people, traders do, but I'm not sure the consumer does. But look at all the similarities. Yeah. Cycle to cycle, and bust to bust, and boom to boom.
That's a way we both live in different industries. Boom to bust, and then bust to boom. All right. Damian, thanks so much. Have yourself a great week.
Thanks, Trev.